All right. Today is Tuesday, March 15th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's start by this. We are seeing oil prices tumbling from the top, at least 30% or so. And this is, of course, hedge funds and a lot of traders and investors booking profits from the oil trade, at least for now. Are the catalysts, the tailwinds that pushed oil prices higher, gone now? The answer is no. They're still intact and they remain strong. But we have a combination of the phenomenon of buy the rumor, sell the news, and the moment we got the Russian sanctions on oil imports, that was the moment that marked the top in the oil rally, at least for now. You combine that with a dent in demand, at least from China, due to the rise of the thing cases. But most importantly, we have de-risking, profit-taking ahead of what? The most important Fed decision since 2008, the financial crisis. Now, as you can see, if we look at the chart of the WTI, for example, it is down around 27.5% from the top, right at the support, at the trend line, which is important. It was support, now resistance, at least looking at today's closing. Similarly, we're seeing palladium, for example. Palladium got whacked in the head, down almost 32.5% from the top. Right, exactly, at the support of the sloping line of resistance, now support. Likewise, when we look at wheat, wheat is down around 23% from the top, and it is now recovering and moving higher again. But the bottom line is clear. We're seeing the unwinding of the Russia-Ukraine trade, lots of profit taking before the most important event for the stock market, which is the Fed FOMC decision. A lot of de-risking, a lot of short covering, as you might have seen today in the stock market, but perhaps we have an important sign, an important indicator, a contrarian indicator that the market has indeed bottomed. And this indicator is the top analyst, your favorite analyst from Fraudstart, Tom Lee. Tom Lee says he admits that he has been too bullish on equities, and maybe we are in a bear market after all. That's it, buy stocks all in, the bottom is here. I'm joking, of course. But the most important point is, all of this profit taking from the oil, palladium, wheat, fertilizer, energy trade, the Russia-Ukraine trade, all of that profit taking is money waiting on the sidelines. It is ammo for traders in their war chest to deploy one way or the other. Either they're going to deploy it back in the same trade, oil, wheat, palladium, the value stocks, fertilizer stocks, agricultural stocks, gold, you know the trade. Or this ammo will be deployed to buy the growth stocks, the losers for the year. And it all depends on one thing. And this is why I've been saying, folks, since the beginning of the week. Over the weekend, I told you, I'm a spectator so far, at least this week, until we get the Fed out of the way. And then we will have clarity and a lot of meat in the bone to chew on. So this is exactly the positioning for now. All of this ammo is waiting and ready to be deployed. Waiting for what? The FOMC, and most importantly, the press conference by Jerome Powell. So here it is. Let's dive into the main topic of this video. In focus tonight, critical decision by the Fed. It is a make or break kind of decision. When we talk about the wall of worry, we have the items, DC, the brothel, Russia, China, the thing, but most importantly, the Federal Reserve, the hawkish Fed. Yesterday, we talked in details about Russia, specifically the exposure of Wall Street to the Russian economy. Today, let's talk about the Fed because we have an important meeting coming out tomorrow. We start with this. You might have heard, not sure, but you might have heard that we have something we call inflation right now. And inflation is surging out of whack. It is impacting everything, and it is becoming a nationwide phenomenon. Nobody can ignore that anymore. Inflation, the last reading according to the CPI, aka the CPLI, is around 7.9% year over year. The highest inflation reading in more than 40 years. No biggie, of course, but you gotta keep in mind this. When the CPLI says it's 7.9%, it is actually 17.9%. Just look at rent inflation, housing inflation, and you know the deal. But inflation is not stopping. Inflation is not peaking. Inflation continues to grow higher and higher and higher because we have the phenomenon of wage inflation. Wage inflation continues to surge on, and you might say that this is a good thing for us, the laborers, the poor, the middle class. Not really, because as you can see, pre-pandemic, It was much more common for the monthly wage growth to outpace the monthly change in CPI. Since the pandemic hit, after the cocaine operation by the Federal Reserve, that is no longer the case. Matter of fact, net, when you factor in inflation, the majority of Americans are losing money. We're down, net. Matter of fact, 64% of Americans now live paycheck to paycheck. We're all familiar with gas and energy inflation, but perhaps the most dangerous inflation out there is food inflation due to the hunger crisis in this country and in other countries. But rest assured, food inflation will continue to move higher and higher and higher. We have a supermarket CEO in New York who says, buy now because food inflation will only get worse. John Casimadidide says food inflation could increase 20% by summer. Why? This CEO sees what's going on in the pipeline, and he sees a lot of shrinkflation in the goods that are about to come in April and May. What does that mean, shrinkflation? It means that companies are shrinking the packages, but they're charging the same price, if not a higher price. This is inflation. So we have more inflation to come, and this guy says buy now. It's gonna get worse. And pretty much in every earnings call that we got in the first quarter this year so far, every CEO says our inflation expectations are for higher prices, so we're gonna stay ahead of the game by price gouging. They didn't say that exactly, but I'm just giving you the real deal. They're increasing prices to stay ahead of inflation. So we're not gonna see peak inflation anytime soon. That is a fantasy, that is garbage, absolute filth, and propaganda. On top of that, we talked in details about the impact from the Russia-Ukraine war and the sanctions on fertilizers prices. These two countries, Russia-Ukraine, happen to be one of the largest producers of fertilizers in the globe. So we're already seeing higher prices for fertilizers out there, which will mean higher food inflation. We haven't seen the end of this food inflation, the most dangerous type of inflation out there. And to pour more gas in the fire, we have, it appears, at least for now, we have a labor strike in a railroad up north in the country we call Canada, and it specifically targets fertilizer shipments in the country that the company we've been talking about a lot in this channel, Nutrien. What does that mean? If the strike goes on and the flow of commerce, this time around fertilizers, not moving from Canada to the United States, then we will see higher fertilizer prices and higher food prices for you and I, the end consumer. Today we got the PPI, for example, the Producer Price Index, and it surged pretty much to historic levels. 10% year over year, the highest in more than 40 years. And the PPI is a leading indicator for the CPI, the Consumer Price Index. So if we have a reading of 10% in the PPI, sooner or later, the CPI will also read 10% too. But rest assured, the propagandists were out of the woods today, and they said, the PPI perhaps is peaking because if you look at the Producer Price Index ex food and energy, it's actually flattening. So maybe we are at peak inflation. They've been jerking off since the morning today, based on that one fact. When they say X food and energy, how about X oxygen too? If you're not going to measure food and energy prices for consumer, what is the point? You've already watered down the CPI formula. It doesn't even count housing or rent inflation properly. And of course, this is done by design, by the way. Inflation has been rising for a long time. For years. But the way they cook the numbers and play with the formulas is to keep the CPI via manipulation tamed, to give the consumer the illusion that inflation is stable and their wages are fine. They're not being diluted by inflation at all. Why do these criminals continue to manipulate inflation data? And they've been manipulating inflation data since time immemorial. Now, why would they do that? The answer is, if they have tamed inflation readings, that enables them, meaning the Fed, to continue to grease up the equities and real estate markets with so-called accommodation, quote-unquote, aka more cocaine to make the rich richer. That is the sole purpose of the Federal Reserve to begin with. So it is not really a government by the people for the people. It is a government by the sheep for Wall Street, Big Pharma, and the military-industrial complex. So yeah, keep voting like a brainless zombie for the same garbage over and over and over again. Have you noticed that in every election season, they always make you vote based on fear, not hope? They always have the narrative of the enemy, the boogeyman, the villain. If you don't vote for us, so and so will happen, so you better vote for us. It's never vote for hope. Vote for the American dream. Vote for affordable home ownership. Vote for a safer America. Vote for a more just America with more opportunities and less manipulation and benefits for the oligarchy. It's never that. It's always based on fear. But anyways, back to inflation. This time around, let's talk about inflation expectations. because this is an important factor in counting inflation. And inflation expectations continue to move higher and higher and higher. Matter of fact, Americans now think inflation will top 6% a year from now. So forget about the fantasy of peak inflation. Not going to happen anytime soon. And all of these clowns who've been saying that inflation is transitory last year, now they're finally waving the white flag and they're saying, yeah, it's going to be permanent inflation. So what? We get to keep our jobs, even though we had one job to do, we f***ed up. I wish I could do that in my job and still keep it. But anyways, now we have Jerome Powell, Papa Jerome, the criminal of the century. He now came out and said, yeah, we should have moved earlier and normalized the monetary policy because we've now created Frankenstein. And I told you in this channel, by the way, the Fed is creating Frankenstein and inflation. We've been ahead of the game. If Jerome Powell listened to this channel, we would have avoided this catastrophe. And by the way, you have a theory. All of these wars and crises across the world, you can tie it back to the reckless policy of the Federal Reserve. Yep, you think Putin would have invaded Ukraine absent of this insane inflation, which is a leverage for Russia? Think again. But folks, the point is, inflation is here. Inflation is surging out of whack. Inflation is a problem. This is nothing new to the viewers of this channel. We already know that. I'm walking you right now step by step to the point of this video. Now that inflation is surging out of whack, and we can no longer deny it, guess what? Expectations for monetary tightening are moving higher and higher and higher. Look no further than the 2-year yield breakout, which is now reaching the same levels of the 2019 highs. Matter of fact, it surpassed that level. When the 2-year moves higher, it is in all likelihood a move higher based on monetary tightening expectations. This is called the short end of the yield curve, the monthly all the way to the 2-year. The Fed has control over the short end of the yield curve. They don't have control over the long end of the yield curve, the 10 all the way to the 30, or even the belly of the curve between the 2-year and the 10. So when the 2-year moves higher in this impulsive fashion, it is a leading indicator for monetary tightening. And already we're seeing global financial conditions reaching the tightest levels in years in a rapid fashion. So you might say, well, the tightening is already here. The Fed doesn't need to act that aggressively at all. Hold your horses. When we look at the U.S. global financial conditions in blue versus the global financial conditions in red, we have a long way to go to get to the point where we can say comfortably the financial conditions are getting tighter. Why are we seeing the divergence between global versus U.S. financial conditions? The answer is we have global central banks who've been already raising interest rates for months now. So global central banks are already ahead of the game in battling inflation. The Federal Reserve, the central bank of the world, happens to be way behind the curve, and they have a lot to catch up on. We're now seeing rate hike expectations moving higher to factor in about 7 rate hikes this year alone. Those expectations went down in the aftermath of the Russian invasion of Ukraine, but they have recovered since then. And we're now factoring in 7 rate hikes. Why is this number important? 7. Hold your horses. We will revisit that in a moment. But we have a Fed zombie from Chicago, Charles Evans, who also reiterated this and said that the neutral setting for this year will be around 7 quarter-point hikes. So 25 basis points, 7 times this year. And of course, this zombie also says and cautions, pay attention now, because he's cautioning that inflation will hit small businesses. Duh. It has been hitting small businesses for months now. Nobody cares about small businesses in this economy. The backbone of this economy is small businesses, and small businesses have been under attack since the thing started. From the lockdowns, the phony loans that were supposed to go to small businesses and it went to Tom Brady and the oligarchy instead. And all of that flow of commerce went to Amazon, Walmart, Target, and the rest of them. Small businesses are getting crushed by this inflation. They have less tools to fight this inflation versus Amazon, Walmart, Target, and the rest. Thank you to the Federal Reserve, you zombie. And that leads us to the moment of truth. Can the Federal Reserve engineer a so-called soft landing? The answer is no, but let's entertain the possibilities using the facts. So far, we talked about inflation and the reality of how inflation is right now and how problematic inflation is right now. And as a result, we also talked about interest rate hike expectations to battle inflation. Now, you might say, what is the big deal here? Okay, we have a hot economy and inflation has risen a little beyond control, and the Fed is responding by increasing interest rates. What is the big deal here? Why the panic? Why is it a big deal if the Federal Reserve is about to increase interest rates 7 times this year? Here is why. Listen to Mohammed Al-Arian from last Sunday.
You're expecting what kind of rate hike, and what is the risk of recession at this point? Goldman Sachs, I know, up their forecast to at least a 20% chance of a recession in the United States.
Yes, and they are thinking that we're going to get 7 hikes this year. I don't think we will get 7 hikes. I don't think this economy can support 7 hikes. And if we do get 7 hikes, we will go into recession. That's the cost of being late. I suspect that what we'll hear on Wednesday, Margaret, is a 25 basis point rate hike. We will hear that more are on the way, and we will hear that they will also contract what has become a $9 trillion balance sheet. We are in this absurd situation that last week, when we got the 7.9% inflation print, the Fed was still putting liquidity into this economy. Mm-hmm. That just gives you a feel for how misaligned policy has been.
Well,
now, Mohammed Al-Arian says that if we have 7 Fed rate hikes, and he doesn't think that we're going to have 7 interest rate hikes, even though the facts that I shared with you just about a minute ago say otherwise. But he says if we have 7 interest rate hikes, the economy will dip into recession. No doubt about it. Why? Again, what is the big deal? If the economy is hot, and we have inflation and growth intact in the economy, what is the big deal if the Fed is going to increase interest rates 5, 6, 7 times? Isn't this what they're supposed to do after all? Yes, but there is a problem. They're too late to the game. They're way behind the curve. What do I mean by that? We already have a phenomenon in this economy called stagflation. You see, when you increase interest rates to combat inflation while the economy is still hot, still in the honeymoon phase of inflation, where growth is still intact in the economy, there is no big deal. The damage will be minimal. You're just going to slow down the economy a little bit to tame inflation. But when you wait for so long, just like the Fed did, you're now seeing growth slowing down while inflation continues to climb higher. When you tighten, as the pace of growth starts to deaccelerate while the pace of inflation continues to accelerate, aka stagflation, this is a recipe to dip the economy into a recession to combat the stagflation phenomenon. Let's hear the facts. Is growth in this economy intact as inflation is, or are we seeing a stagflation for real? One indicator is job creation in the economy. If we look at the last employment report from the Kitchen, the Bureau of Labor Statistics, and we take that at face value, the economy is still hot. The pace of growth in this economy remains intact because we've created hundreds of thousands of jobs last month, 179,000 jobs in the leisure and hospitality sector alone. So you look at that indicator and you say, okay, growth is still intact. Perhaps if the Fed increases interest rates right now, no harm will be done to this economy. Here's the problem. Last week, we got a report, the initial jobless claims, and they went higher by 11,000 jobs to 227,000 claims after big increases in New York and California. This is a little tiny leading indicator, if it sticks, that the economy is starting to lose that pace of growth. The pace of growth is deaccelerating while the pace of inflation continues to accelerate. Another indicator that we got today, the Empire State Manufacturing Survey. Look at the chart below. Whoops. We're back into negative territory in a rapid fashion, and we've only seen these readings during recessions, as you can see from the areas shaded in gray. So the Empire State Manufacturing Survey is dropping like a rock. This is an alarming signal. The pace of economic expansion, the pace of economic activity is slowing down rapidly. Yet according to the latest readings that we got for the CPI and the PPI, inflation continues to move higher. This is classic stagflation, and hence, when the Fed tightens under these conditions, the economy becomes a little delicate and fragile, that perhaps the Fed could overdo it and the economy can dip into a recession. The problem is, absent of an action by the Fed, inflation will continue to move higher, and we will live with stagflation for a long time. And stagflation is the worst, the most destructive economic phenomenon out there. Now, this is important, so pay attention and close that nasty tab that you have open on incognito, because they're never going to teach you this on TV or even in college. If you're in college right now, your macro professor is not going to teach you this at all. He's going to teach you propaganda. So here are the facts. Because in the morning, the CNBCs and the likes, they've been jerking off a little too aggressively, I would say. Looking at this, they're saying yes, the PPI was hot year over year, but when we look at the pace of inflation in services, it is receding, it is flattening, plateauing, and it is moving down. So inflation is topping, inflation is peaking. Wrong. I've never seen such stupidity in my life. Here are the facts. Goods in black, services in pink, whatever that is. We look at goods as a parameter for inflation in the economy. On the other hand, we look at services as a parameter for growth in this economy. Why? If we have a healthy economy with a healthy consumer and an abundant supply of reserves, the consumer is so strong, flush with cash, they're going to go ahead and spend on services, booking hotels, vacations, restaurants, theme parks, casinos, doing economic activities. And this is the core of any economy. But when we look at this chart, we're seeing services inflation moving down while the inflation in goods moving higher. Meaning we're seeing less spending on services and more migration of that spending from services back to goods. Why? Because the consumer is chasing inflation. The consumer has to budget and allocate their reserves accordingly. They can spend less on restaurants and vacations and services when they have to spend more at the grocery store, buying goods, not services. So we're seeing that spending migrating from services to goods, indicating that the pace of inflation is moving higher while the pace of growth in the economy is stagnating and now moving down. This is an alarming development not worthy of jerking off to. And even former UK central banker Charles Goodhart says inflation will stay high for decades. Decades, not transitory. And this solidifies the argument for stagflation, that we're already in stagflation and the stagflation problem will get worse and worse and worse. Take, for example, the survey from Bank of America to global fund managers. The chart's a little hard to read because the geniuses are using the same colors, but look at that light blue, which is spiking higher. The expectations right now for the global economy in the next 12 months, according to these global fund managers, is below trend growth and above trend inflation. What does that mean? Higher inflation, lower growth, aka stagflation. So stagflation is quickly becoming the consensus among global fund managers. And this leads us to the problem with the Fed. If we had higher inflation hand in hand with higher growth, then it doesn't matter. The Fed could raise interest rates once, twice, 3, 4, 5 times, doesn't matter. But when we have higher inflation, lower growth, thank you to the reckless and callous policy by the Federal Reserve being way behind the curve, they're now getting to the point where it is too late to tighten. Because if you tighten now, you're gonna get a recession, no doubt about it. The problem is, if you don't tighten, then the alternative is either hyperinflation, stagflation, or a depression. Everything falls apart. Look at the yield curve, for example. It is quickly accelerating toward inversion. And every time we saw an inversion in the yield curve, it was always a leading indicator that a recession is around the corner. And this is exactly where we're heading right now. Of course, when Bank of America asked the global fund managers in the survey, what is the biggest tail risk right now? Last month, it was the hawkish central bank policy. This month, it is the Russia-Ukraine conflict. Why is the Russia-Ukraine conflict relevant to what we're talking about here? Because the situation was bad to begin with. The Fed was already behind the curve, fighting inflation. Now, the Russia-Ukraine conflict poured more gas to the fire of inflation by the shortages of wheat, oil, gas, neon, all of these materials that come from these two countries. On top of that, the sanctions and the trade restrictions, all of these will impact inflation higher. And that makes the Fed even further behind the curve because inflation just took a massive leg higher due to the Russia-Ukraine conflict. And I said, when all else fails, they're blaming this inflation on Putin now. They blamed it on the thing and the supply chain constraints. That did not work out. They now have a new boogeyman. Let's blame inflation on Putin. When that stops landing, they're going to resort to flat-out manipulation of the data. They're already manipulating the data, but watch. You might hear that the CPI reading next month actually went down. Surprise, surprise. Even though commodities are moving higher. What? Because they're manipulating the data. That is the last resort. Look no further than the article that we got today from the New York Times by propagandist Paul Krugman. And I don't expect anything but propaganda from Paul Krugman because he is a professional propagandist. But the article reads, how not to have a Putin recession. Oh, it's a Putin recession now? Listen to the gaslighting and the ridiculing of the intelligence of the average American, as if we've never noticed that inflation was moving higher before the war. This is not going to land. This is suicidal by the Democratic Party and their allies and propagandists. Bad strategy. You're better off being frank and straightforward with the American people by saying, hey, the Fed screwed up. It's not our fault. The Fed kept printing money out of thin air, propping up Wall Street, and this is the price to pay. But whoops, we renominated Jerome Powell, so we just renominated our boogeyman, so we cannot use that. We have to stick with Putin. But rest assured, it's not just the propagandists, Paul Krugman and the others, but even the Wall Streeters are also now calling for the Federal Reserve to be dovish and not to tighten too aggressively, meaning who cares about inflation? We can live with inflation. We'll pay $15 a gallon for gas to do the moral right thing. They're out of touch, out of mind with the poor and the middle class of this country. And they would rather have a higher stock market, higher inflation, rather than crashing the stock market and perhaps tackling inflation and making life better for the poor and the middle class. Wall Street sends fresh alarms on bond liquidity as QE era ends. What are they talking about? Here it is. Like his Wall Street peers, Mark Cabana has had it with terrible trading conditions in the world's largest bond market conditions that could worsen now that the Federal Reserve has just wrapped up its biggest asset buying program in history. See, I work in this business. These so-called Wall Streeters and strategists and money managers, they're lazy, they're clueless. They've been just riding the wave of the Fed's liquidity for almost a decade now. Put your blindfolds on and buy whatever, specifically the high growth, high multiple mania stocks, and you'll do just fine because you have the big guy with the printing press continuing to buy. Even a child, a dog, a cockroach could have performed really good under these circumstances. All you have to do is just buy. But now, all of these Fugazi managers and strategists have to actually face the music whether they have skills or not, because you cannot just ride the Fed's liquidity and buy ETFs. You gotta be a stock picker. Either you know what you're doing or you're not. And they're all afraid of being exposed. Continuing. In a Wednesday note titled UST Liquidity Sounding the Alarm, the head of the U.S. interest rate strategy at Bank of America stepped up his calls on policymakers to embark on a root and branch reform of the underlying marketplace for the world's safest assets. He warns that if Russia's invasion of Ukraine continues to exacerbate long-standing liquidity woes, the Fed could be forced to delay plans to later this year begin allowing debt to roll off its balance sheet, known as quantitative tightening. We see rising odds of Fed action to support UST market functioning, Cabana and colleagues wrote. Or market functioning? What does that mean? You know what that means? When they say market functioning, it means they want the sugar daddy to continue to buy bonds. Otherwise, they're toast. A Bloomberg measure of liquidity deteriorated this week to the weakest since the pandemic spurred disruptions in 2020, in part because banks are less able to hold sufficient inventory of treasuries, given regulatory constraints on their leverage. That is spurring strategists like Cabana to up their demands on the Treasury Department to consider liquidity-boosting efforts like buying back older securities and cutting auction sizes in the least traded corners of the yield curve. Impaired Treasury functioning risks triggering global market volatility and can ultimately gum up the ability of central banks to administer monetary policy. Or you think? There is a price to pay here, folks. You've been partying for over a decade. You think when the cocaine is lifted out of the market, we're not going to see a withdrawal? This is the withdrawal, and we have to face it. We continue to expect Treasury markets functioning to remain somewhat challenged, said Parveen Korapati, chief rate strategist at Goldman Sachs in a note. He also added, in the absence of the Fed's backstop, quote-unquote, presence, we believe it may take time and greater certainty in the geopolitical outlook for liquidity to materially improve, suggesting ongoing risk of somewhat disorderly yield swings. It's also called a free market. I don't know if you heard about it or not. The sugar daddy, the cocaine supplier, has to get out of the picture, whatever the ramifications might be. Continuing, rising volatilities unmasking deficiencies at the heart of the debt market. Yields have taken a wild ride, with the war triggering a flight to quality bid, while the Fed's upcoming tightening plan emboldens bears. And of course, they're saying Powell admires Paul Volcker. He may have to act like him. Jerome Powell doesn't have the spine. Jerome Powell is a coward. He's a puppet to the banks and the globalists, and he will do whatever he's told. He knew that he was wrong. He was behind the curve. It was a time for a 180 last year to tackle inflation. But again, because he's a spineless puppet, he is no Volcker. Not even close. He kept getting orders. It's not time, pal. It's not time. We gotta wait. Because inflation might be transitory. I know, by the way, us insiders are not finished dumping stocks yet, so give us a little more time. Anyways, let me know in the comments. You think Powell will find his inner Volcker, or will he remain a spineless coward? Anyhow, we're gonna move on to cover the market information today. We start with the market closing, and here we go. The Dow Industrial Average up big, 599.10 points, or a gain of 1.82%. The Nasdaq leading the gains, up by 367.40 points, or a gain of 2.92%. The S&P 500 in the green by 89.34 points, or a gain of 2.14%. Yesterday, they served the pies to the bulls. Today, they served pies to the bears. You get a pie, she gets a pie, he gets a pie, everybody gets a pie. And therefore, yours truly has been staying on the sidelines. What about the sector's performances today? Leading the pack at number 1, capturing the gold medal, technology. Number 2 for the silver, consumer cyclicals. Number 3 for the bronze, communication services. The laggard for the day, and the only laggard, energy, closing in the red big time. This is the rotation, the Russia-Ukraine trade, back to the growth and momentum trades, betting and assuming the Fed will be dovish tomorrow. What about the advance to decline ratios? NYSE 70% advancing versus 26% declining. The Nasdaq 62% advancing versus 33% declining. Moving on to commodities. Big down day for energy. Crude oil was down big. The WTI down by over 7.5% today. Brent, on the other hand, was down almost 7.75%. Now, the big question is the following. Will that ammo, all of that money on the sidelines the traders made, will that money go back into buying crude, or will that money go back into buying Apple, Tesla, the Chinese dip, software, chips, you know the deal? It was really tempting for me today, given the big down day for crude, to buy some futures contracts, or even to buy the dip in ETFs like the OIH, for example, but I did not. I gotta see what the Fed's gonna say. But make no doubt about it, they're gonna buy the dip in oil sooner or later. By the summer. If the Fed says 25 basis points tomorrow, by the summer, crude oil prices will be back at 100 easily, if not way beyond that. But even gasoline prices are down. Today, took it on the chin, down almost 7%. Heating oil down big, a little over 8.5%, while natural gas down a little under 1%. What about softs? The leader of the day, lumber. Lumber closing the day with gains of over 5%. Likewise, we have modest gains for OJ, a little below half a percentage point, while cotton pretty much in the flat line, be it closing in the red. The decliners for the day, led by cocoa. Cocoa down almost 3.75%. Coffee continues to slide down, losing a little over 3.5% today, while sugar also in the red, down by more than 2%. What about metals? Down across the board. Gold, silver, platinum, copper, all down. But check this out. Palladium is stabilizing, barely in the green. Of course, the biggest loser today was platinum. Platinum was down a little over 6%. So we're seeing a little bit of unwinding and profit taking in the commodities trade, but all of that could change by tomorrow. What about meats? Modest gains across the board. Live, feeder cattle, lean hogs futures, all in the green, be it modestly. What about grains? Here we go. Wheat is rebounding higher, gaining a little over 5.5% today. We also have gains for corn, a little over 1%. Rough rice, oats, all closing in the green. Well, we have a down day for canola, soybeans, and also soybean meal and soybean oil futures, be it modestly in the red. Moving on to the big casino, the options market. What's going on here? Leading the pack at number 1, Apple, with around 1 million contracts traded today. About 59% of those were calls. Tesla, the souffle, number 2, with a little over 700,000 contracts. We have a recovery in the call to put ratio because we're seeing more calls today. About 52% of the bids on Tesla's table today were calls. And number 3, AMD, with a little over 400,000 contracts. About 57% of those were calls. And again, you look across the board, whether we're talking about Alibaba, Meta, AMC, we're seeing more call options buying. The ratios are tilting a little favorable to calls than puts. Moving on to the unusual activities that took place in the options market today, we start with the ticker IWM for small caps. This time around, they're buying puts, the 184 puts for the expiration date, March 25th. just around the corner next week, and they're betting that the IWM will drop down by more than 6% by then. They paid around $1.35 apiece to enter this trade, all in all spending about $3 million. And here's the trade for Alibaba, the ticker BABA. This time around, they're buying calls, but with a shorter expiration date. They bought the $90 calls with the expiration date this Friday, March 18th, with expectations for a big rebound for Alibaba by over 17% by Friday. They paid around 45 cents apiece to enter this trade, all in all spending about $800,000. There has to be some short covering by the end of the week for Alibaba, and this is what they're betting on. What about the trade for the ticker BP for, you guessed it, BP? They're buying puts, the 24 puts for the expiration date May 20th, with expectations that the name could drop down by more than 14.5% by then. They paid around 70 cents apiece to enter this trade, all in all spending about $700,000. What about the trade for the ticker AAPL Apple? They continue to buy the dip via calls, this time around the 175 calls, with the expiration date April 29th, with expectations that the name could pop higher by more than 13% by then. They paid around $1.15 apiece to enter this trade, all in all spending around $1 million. Lastly, what about the trade for the ticker TSLA Tesla? They're buying the 935 calls for the expiration date April 29th, with expectations that the name could pop higher by more than 16.5% by then. They paid around $25 apiece to enter this trade, all in all spending around $17 million. Notice the theme here. They're betting that Alibaba, Apple, Tesla will bounce higher. They're betting that BP will take another leg down. This is oil, energy. They're also betting that the IWM will go down. Interesting. It's a mixed message, but they continue to buy the dip in the Qs, the technology trade, Apple, Tesla, as if they're already betting that whatever Powell says, the market will like it and we will see a massive relief rally higher, lots of short covering, specifically in the high multiple names. We'll see. The pies are hot and ready to be served. So why not just wait in the aftermath of the Fed's meeting and then take decisions? Anyways, moving on to the heat map analysis, a sea of green across the board. The only exception is energy and the metals trade that has been working due to the Russia-Ukraine conflict and higher inflation expectations. Even the Chinese names rebound higher today, with the exception of Alibaba, which is becoming a little sexy, to be honest with you, for a calls option trade. A short-term bounce based on oversold conditions, why not? I'm thinking about it. I might do it tomorrow. Buying calls on Alibaba. But again, you could buy the dip in Chevron. All of you have been asking me, when should we buy the dip in energy? When should we buy Exxon, Chevron? Well, they're down big now from the highs. Are you buying? The answer is not, because you're afraid. Yet the moment they rebound and they start trading higher impulsively, the FOMO kicks in and we start chasing the move higher. I'm not saying you should buy energy right now. We gotta see what Powell's gonna say. But again, nothing to read here in the heat map analysis. It is what it is. They're taking profits from energy, and we're seeing short covering across the board. Because if this was a rotation, you would have seen energy down, and you might have seen chips or software lighting up green, but you're not going to see everything lighting up green. Defensives, utilities, industrials, financials, that tells you the algos and the short covering did the job today. Now we have news for the souffle. We talked about price hikes due to the rise in inflation. And here we go. This is the second time in a week with the souffle up prices for Chinese and US consumers. Luckily for Tesla, for now at least, they have the pricing power in the US and in European countries, Norway, Germany, the affluent consumer. But will it be the case in China? And what about the expansion, dreams, and hopes for Tesla if they continue to push prices higher? Something to think about. I'm also starting to get concerned about the entirety of the auto manufacturing industry. I'm shopping for a car right now. Not for me, I don't need a car. I work from home, at least for now. All I need is the donkey in the backyard. He's doing the job impressively. Go to the grocery store, no need for gas, and who cares what people think? If you see somebody in San Diego riding a donkey in a main street, that is me. But anyways, we're looking for a car for my wife, and there is no inventory. It's gone. And now we have more shortages and more price increases, not just for the traditional gas combustion engines, but even for EVs. Everything is moving higher. There are shortages across the board, and now we have Toyota, Honda, and many other manufacturers, VW, all halting productions, cutting productions. This is not good, folks. The hope was once the thing is out of the picture, we will see a ramp up in production of vehicles and the inflation in used and new cars will be tamed down. This is not the case for now. We have a severe shortage in new cars, and this will continue to push used cars inflation higher and higher and higher. So that makes me concerned about my auto investments. I have Ford and Honda, that's pretty much it. Now, I bought Ford at $8 a share, so I'm not worried right now, but what is the point when you say, you know what, hit the cha-ching button and cash out? I think that point is getting closer. We also have news for Facebook, and now we have Zucchiniberg who says NFTs are coming to Instagram. You know what? This is the beginning of the end of Facebook, as we know it, as a company. This man has lost his mind with the metaverse stupidity, which is a glorified video game to begin with. Your business is advertising. Concentrate on that. But no, he already cashed out, by the way, billions of dollars, and now he's just experimenting with the company. I don't feel safe at all buying the dip in Facebook. I think we're seeing the beginning of the end of Facebook. Moving on to the heat map for the ETFs. Again, lighting up green with exception of what? Energy, XOP, XLE, OIH, down big. The inverse indices are down big. SQQs, SPXU. The VIX proxies were down not by a lot today. The VXX was pretty much flat. Let's talk about the VXX for a moment because, as you can see, a massive spike in buying for the VXX. And the assumption is retail traders and investors bought the VXX. But every time the little guy wins, they have to slam the door shut right away. And now they banned the issuance of new shares of the VXX, meaning you're stuck. Why? Because they want to prop up the stock market higher. If we continue to buy the VXX in oil ETFs, then oil prices will move higher, the VIX will spike higher, and equities will go down. This is just algorithmic reaction 101. So to prevent that, what do they resort to? Market manipulation, suspending the trading of the VXX and oil ETFs. So for all of the apes and the morons who kept saying the shorties are manipulating the market, the dark pools, yada, 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 do you now realize that 99% of market manipulation happens to the upside, propping up stocks higher at any cost? Back to the heat map, look at the contrast between growth and value. Growth is outperforming value by a lot, and this once again affirms the sentiment that we're seeing so far of market participants assuming that the Fed will be dovish and whatever Powell is going to say, the market will like it and it will be interpreted as the following. It is time for the rotation from value, the inflationary trade, back into growth and momentum. The RKKs of the world, the software and chips of the world. We'll see. It is an assumption for now, not written in stone. A lot of things could go wrong, and we have a lot more pies to serve. Lastly, what about international markets? As you can see, the EWZ is down, Brazil is down. European markets are stabilizing, but here we have data. And as you can see, the biggest outflow from European equities in history. This doesn't happen by coincidence, folks. This is more than a bear market. What we saw in European equities was nothing mere than a bear market bounce. We will see the resumption of selling sooner or later. Japan, the EWJ, led the day, but look at the consistent performance of India. INDA continues to move higher, and I still like the Australian EWA and Canada EWC along with the EWZ. We just need a better dip to buy here. But mind you, it's going to be volatile because of the elections that we have in Brazil in October. Moving on to charts, and we start with SPY, the S&P 500 30 minutes chart. A lot of progress by the bulls today. We had some oversold conditions yesterday. You combine that with the psychology that we have an important FOMC decision, and you want to cover your shorts before you head into that decision, and you have the pop that we got today. But why was today an important win for the bulls, at least in the SPY's chart? Number one, they managed to recapture 422 as support. They closed at the highs of the day. Number two, what if this is a reverse head and shoulder formation? We will see higher highs, and sooner or later the SPY will close above the line in the sand 430. Number three, what if this is a double bottom? And sooner or later we will have the energy for the chart to go and close above 430 and close that as support. The bulls would argue, we have retested the lows over and over and over again. We think that we have a solid bottom for now that we can work with. The bears will counter and say not so fast, because all of what happened today is a mere oversold bounce combined with short covering ahead of an important decision by the Fed. So don't read too much into it. We saw the pies being served, and the pies are still ready. We have an abundance of pies, so hold your horses. Now, when we look at the continuous contract for the SPY from a daily chart perspective, the argument for the bulls is still intact because we're seeing a formation of a higher low. The support of 4,102 has yet to be broken. We're seeing the volume spiking higher on an upside day on the buying. Be it the shorts, be it the algos, doesn't matter. We saw a lot of buying today. The momentum indicators are stabilizing. Yes, they remain in negative territory, but they're stabilizing. And on top of that, the bulls recaptured 4,232 as support. I'm not going to read too much into it. Yes, the bulls made a lot of progress today, but who's to say that we're not going to see a flush down day tomorrow? Whatever Powell says, the market doesn't like it when we go down. So we're going to wait and see what happens after the conference. Now, if the chart breaks above the sloping line of resistance and it closes above 4,384.5, then you have your answer. We got the bottom, at least for a few weeks, if not months, that we can work with. But absent of that, it is just too early to say that this chart has bottomed. Moving on to the Q's 30 minutes chart, we saw what it appears to be a bear flag formation, but I cautioned and I said, look at the RSI from a 30 minutes perspective. It was severely oversold, so we could see a bounce and this bear flag might not work. I would have liked to see 316.46 being tested, but that didn't happen. The chart moved ahead, forming a bull flag formation only to close at the highs of the day. But all in all, the chart remains in purgatory between the support of 316.46 and the resistance at around 334. Can you read into it? Yes. You could say this is a reverse head and shoulder formation. Sooner or later, the chart will break above 334 and then some. It's going to recapture 343 as support once and for all. We'll know this was the bottom. The problem is, it is just too early to say. For all you know, we could flush down and we have another bull trap. And therefore, yours truly right now is doing nothing at all. I'm just watching. Here's a daily chart for the continuous contract for the Qs. Big progress for the bulls. They have recaptured the trend line in yellow as support, and then some. They managed to recapture 13,300 as support. The volume spiked higher on the buying side today, even though the momentum indicators remain negative. So all in all, yes, we have a progress by the bulls, but not enough. Not convincing enough to buy the dip and assume that we're heading higher. This will not happen unless we see a break above 14,000 once again. That's a long way to go. Now you might say, why should I wait till 14,000, Maverick? Because you don't want to be stupid, right? You don't want to eat pies. You might think pies are delicious, but your waist size is going to grow a little larger than you would like. If the chart goes and closes above 14,000 as support, there's going to be plenty of meat in the bone to chew on. But right now, it is just too risky to buy. We got to wait for the Fed to get out of the way. What about the IWM 30 minutes chart for the Russell 2000 small caps? It went down almost to 191.5, and today it gapped higher, formed that little bull flag that extended for a little while, and then came the pop by the end of the day, and the IWM also managed to close at the highs of the day. You could argue that this is a higher low formation. You can read into it however you like. The problem is the chart remains in purgatory. The support 191.5, the resistance 196.5. Unless one of these two is broken, you cannot do anything here. There is no buy or short signal. What about the Dixie, the dollar index? A critical day for the Dixie tomorrow. It is hanging around the highs. It is waiting for Powell to give the green light to break above 99.9. Let's round that up and say 100. Why? 100 becomes a psychological level to hit. And if that happens, we will see panic in the equities market because the dollar, the rise of the US dollar, will crush the margins of multinational corporations. But the chart is also facing overbought technicals. Overextended technicals, both in the RSI, the MACD indicators. What does that mean? If Powell comes out a little bit dovish, this chart will flush down perhaps all the way to the support of 97. So we have a lot of volatility to watch for tomorrow. And this is one of the most important charts to watch. Grab the popcorn. We have an interesting show to watch tomorrow. Another chart highly critical to watch, gold. Gold is now below the Fibonacci level of support at around 1,910. It is not a big deal yet, because we haven't closed the week below that. And you could argue that this support is actually 1900, so we can play with the number all we want, but a weekly closing below that line, below that zone, below 1900 will seal the deal. The problem is, the fundamentals for gold are still intact, meaning the dip is an opportunity to buy. The problem is we have overbought technicals. A lot of these overbought conditions are being worked out right now. The RSI is back within average range. The MACD is about to do the same. But most importantly, this chart is waiting for the Fed. If the Fed comes out too dovish, the money will flow back to equities. If the Fed comes out a little hawkish, opening the door for more interest rate hikes, sounding the alarm about inflation, then you will see this chart recovering right away. What about the 10-year yield? Another important chart to watch for tomorrow. It has been on an impulsive ride higher, not quite overbought on the technicals, but the chart has been moving higher on higher inflation expectations and most importantly, higher hike expectations. If the Fed comes out a little more dovish, Powell says, yeah, we'll do 25 right now, but we're not going to commit to anything more than that, will be data dependent. This chart will go down dramatically to the support at around 1.94, and we will see technology outperforming tremendously. But if the Fed opens the door and commits to perhaps 5, 6, 7 rate hikes, this chart will blast higher to the next resistance at around 2.4, and we will see financials outperforming. So you gotta watch technology, the software names RKK versus financials. What about the TLT weekly chart? It is below 134.5. We're now waiting for the weekly closing. Is it gonna bounce higher, closing the gap, and perhaps reclaims 134.5? As support, or will it close the week below 134.5? We will know right away tomorrow. We're not going to wait till the end of the week because this chart will move significantly higher or to the downside based on the interpretation of what Powell is about to say. But again, this is a weekly chart looking at the technical lens alone. You're not going to see a gap like this, a gap down left open for too long. The chart will close that sooner or later. And the assumption for now is yields will go down, TLT will move higher after Powell speaks, because usually, not always, the opposite trade for what's been going on heading into the meeting and the decision takes place. In this case, yields have been spiking higher. So if we do the opposite of that, yields go down, TLT goes higher. This is the assumption, not what will happen. This is why I'm staying out in the sidelines. What about the VIX 4 hours chart? Look at this. The MACD indicator has yet to cross, producing green impressions in the histogram. What does that mean? The VIX remains in bearish formation, meaning that the SPY should continue to move higher until we have a crossing in the MACD indicator of the VIX showing green impressions on the histogram. Not just a little baby impression, but a consistent pattern of green columns on the histogram. Another important win for the SPY's bulls today is the fact that the VIX tried in an attempt to break above 33 and it failed. Could this be an indicator that the VIX is done rallying higher and we will see a massive rally in the SPY? Perhaps, but you cannot say that because look at where the chart is trading. It is eerily close to 33. Who's to say that this chart is not going to curl its way higher and give it another shot and it's going to break above 33 and we will see the VIX making higher highs? This is still on the table. We're not going to say that the VIX is done yet until we see this gap that I'm pointing out right now being closed and a failure to bounce from that gap on the VIX's chart. What about the VXN 4 hours chart? Again, we're not seeing green impressions on the histogram of the MACD. This is good news for the NASDAQ bulls, bad news for NASDAQ bears. But the good news for NASDAQ bears is the following. The trend in the pattern of higher lows remains intact. The bad news for NASDAQ bears is the following. The pattern of higher highs is now done, at least from today's action. But the NASDAQ bears will continue to hold on the fact that this chart has yet to close below 27.5. It remains elevated, indicating higher risk in the NASDAQ. So who's to say that we're not going to see a massive pop higher above 40 all the way to 45, 44 right after Powell speaks? You cannot argue against that. All possibilities are on the table, and therefore, once again, I'm staying on the sidelines until further clarity. What about Apple? The daily chart, we have a bounce day off 150, not quite to 157 as resistance, so closing the gap and then closing the day without making a definitive move one way or the other. But the facts are the facts. Apple remains in purgatory between the support 150, the resistance of 157. So yes, we have progress by the bulls, but it did not change the facts. The volume went a little higher on a buying buying side, but look at the momentum indicators, they remain in negative divergence. So once again, yes, an upside day for Apple, but it did not change anything, technically speaking. What about Tesla, the souffle? We have a move higher, closing above the sloping line of resistance. This is a good sign for souffle bulls. We saw some severe oversold conditions on the 30 minutes chart, the hourly chart, and we're seeing a bounce off that. The problem with this chart, as in many other charts, that this bounce is not definitive yet. We need to see a confirmation. And my hunch is this chart has been looking for support over and over and over again at around the sloping line in yellow, at around 782.5, and around many other levels before. And it did not find solid hard rock support. The only solid support that we have in the chart right now is at around 700. That was the big bounce that we saw a few weeks ago. So the assumption from now is the chart will not make it. It's not going to be able to hold unless it has another level of solid support, or we're not even close. So the assumption is this chart will go down to 700 and then it finds support around there. Do you bet on it? As a Tesla bear, do you buy puts right now? Of course not. Because what if Powell comes out accommodative, quote unquote, tomorrow? And that doesn't mean shit, by the way. All what it means is what the market thinks Powell said. If the market thinks that Powell said something positive, you will see a lot of short covering, a lot of call options buying in this chart, and it's going to blast higher. And the next level we're looking at is around 866.14. Long shot, but for now, too risky to make one move or the other. Too risky to bet one way or the other until the Fed gets out of the way. What about BTC, Bitcoin? Again, in no man's land between the support 35,750 and the resistance at around 42,000. Waiting and waiting and waiting for the Fed's decision. And the aftermath of that. Are we going to do any decisions right now in this chart? Of course not. Absent of two things happening. Either the chart's going to break below 35,700, that will be a shorting signal, or either the chart's going to break above 42,000 and the triple top, the three amigos, and that will be a buying signal. Lastly, what about AMC? Look at that. It popped its head multiple times at around the resistance of 14.24 of oversold conditions on the hourly and 30 minutes chart, and it made it above 14.24. It is now support. It wasn't an easy ride, by the way. When we zoom into a 5 minutes chart, as you can see, AMC tried over and over and over again before it made it once and for all above 14.24 by the end of the day. Now we have news that might have impacted the move in AMC, and it is the fact that AMC bought some gold. They bought a gold miner. Weird, peculiar, doesn't make sense, surprising, whatever you want to call it. The digestion will happen. Was it a good move? Was it a bad move? Because the apes, the AMC investors, would rather see the money goes back into the company, either by share buybacks to force short covering, or by paying back debt, or better yet, investing in the company and expanding it more. So this is a weird move. I don't know what to make of it, but I have a hunch that we're now going to see the correlation between AMC and gold, at least in the short run, meaning if gold pops higher, we will see AMC also popping higher. If gold goes down, so will AMC. Is that good? Is that bad? It depends on your outlook for gold. But again, a weird move. When we talk technically speaking, the recapture of 14,000.24 support is a positive development, not a negative one. But the most important threshold is, where will the chart close the week? Above 14.24 or below that number? Closing below that number is a sign to short. A closing above that number is a sign to buy. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? A critical day, highly important. We have retail sales. We have the import price index. We have the NAHB Home Builders Index. But most importantly, we have the FOMC announcement. We know they're going to raise rates by 25 basis points, not a surprise. So the most important item is the press conference by the big dog, Fed Chairman Jerome Powell. And honestly, it doesn't matter what he's going to say. We're going to see the typical knee-jerk reaction with the algos popping stocks higher or dropping stocks down. And then usually the opposite happens by the end of the day. So you gotta wait till the end of the day to see the final move. And even after that, we're gonna have to digest the move, hear what he said once again, and then after the digestion, we make the move. A lot of sexy opportunities out there. Do you buy the dip in oil? Do you buy the dip in Apple? Do you buy the dip in gold? All opportunities, but we're not going to know until we know. So until then, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.